Hello and welcome to today's premium account market update for January 2016. Any individual reading or listening should discuss with their financial planner and advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hein, Managing Director of Investor Signals. The topics for today, we look at the macro update driving equities. We roll through the ASX Top 50 with a focus on FES 16 earnings. We look at the technical trends, portfolio allocations and conclude with a short-term market outlook. The Investor Signal Services a model portfolio of ASX 50 stocks. We look at call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow, generating capital growth, all under a strict investment mandate, and the assets remain in your name. If you'd like to know more about the service, please contact me, leon@investorsignals.com. Moving straight into a graph of the US market, obviously equities have been under a lot of pressure at the moment. There's been the perfect storm between the selling pressure in China, the selling pressure in oil, and the Federal Reserve raising interest rates in December, and the market having to get used to the fact that the Federal Reserve's not going to be there to bail the market out on every sell-off. That's creating volatility and an adjustment in PEs. We're seeing S&P 500 earnings come through at the moment. Last week we had the early start of earnings with Alcoa and some of the large US banks. Over the next week or so we get into the big technology companies. I think that'll probably short-term underpin equities, and maybe we get a little bit of stabilisation over the next week or two. But the broad backdrop for equities is we're in a negative technical structure and pressure's still to the downside. Just to have a look at sort of one of those benchmark indexes here in China, the Shanghai Composite. So if we look back in August, the market hit its low, rallied back up to 3,600 on the index, and then we've given all that back over the course of the last few weeks. What's the unknown at the moment is, can the index stabilise here, or does it have another leg lower? It's very rare for when bubbles burst in most of these indexes to have too much more than a 50% correction. So one would think that we're probably pretty close to the support, and in all probability we don't get that next leg down to 2200. That would be a pretty excessive sell-off, probably something in the order of, getting to 60 to 70% retracement of this rally up here, and that's large by any standards when you look at historical bubbles that have burst in equity indexes. Quick look at gold. There's been a lot of commentary in the market about the prospect of gold performing well should equity markets remain under pressure. What we're seeing here is obviously a reflection of the strong US dollar, which has put downward pressure on gold, and it's continuing to make lower lows and lower highs. But we'll keep an eye on this in the coming weeks and months just to see whether we get a reversal and a shift to a higher high structure within the gold commodity there. US 10-year Treasury, so we've seen a slight ratcheting back of expectations of US interest rates increasing in 2016. So we've seen that reflected in the 10-year bonds in the US trade from 2.4 back to just over 2%. Going to the domestic market, this is an index of the top 50 stocks on the ASX. The technical structure is still negative, and as we roll through the top 50 companies, we'll see that prevalent in most of the charts, with only a handful actually generating buy signals. So on that note, let's move straight into the top 50 stocks, and I'll provide brief commentary as we move through them. AGL, I think, is expensive up here on a 4.5% yield. I think most of the good news is priced in. We're not buyers unless we see a pullback over the course of this year to around 15.50. Asiano's coming off its highs as a result of uncertainty around the Brookfield transaction. Amcor, I think this is a buy on the dip here. It's one of the few stocks that we've been buying in the last few days. We've been pretty aggressive with the selling covered calls, and it really is a matter of generating that cash flow from the call option and the dividend in Amcor. Underlying growth about 5 to 6%, reasonably defensive, and it's one of the few stocks that we're comfortable buying at the moment. AMP, technical structure still to the downside, maybe value starting to creep in, but we're not doing anything in AMP at the moment. ANZ, as with all the Australian banks, I think there's probably starting to represent some value here, and we may see a short-term bounce. APA, so this area of the market where infrastructure is involved and the income stream's defensive, as is the dividends, is probably the area to be when looking for buying opportunities. So again, this is one of those few stocks that has a buying signal, and we see sort of this 825 as reasonable support. ASX, 5% growth, 5% dividend. The stock's likely to trade sideways. I think 37 support, 42 is resistance. I don't expect it to break out of that throughout the course of 2016. AZJ, Earnings downgrade here, something in the order of around 25%. We've seen that reflected in the difficulties for the company growing top-line revenue, and we've seen limited growth in the haulage numbers. Asset write-downs through their exposure into the iron ore business in WA. I think, look, you're probably getting down to a level where Aurizon bounces. This was a stock that we had been regular buyers of throughout this period, and in most cases we've taken profit. It was on our radar as something looking to step back into, but we haven't yet been, new purchases of Aurizon. I find it, quite surprising to see the value down here. I think maybe a rally back to 450 could occur over the coming weeks or months. BHP. So with oil back at $27, $28 a barrel, iron ore back at 40 a tonne, there's not much good news for BHP. We're seeing the asset write-downs of their shale assets in the US. And still the ongoing problems generated from the mine collapse in South America. In saying that, look, there's only so much, there's a lot of bad news already priced into BHP, and one would think we're probably getting reasonably close to some small bounce there in BHP. Brambles, so again, this is one of the few stocks that we're buyers of. We think the US dollar exposure, underlying business growth around 5 to 6% makes it defensive, but we're very aggressive with the selling covered calls. It's a case of collecting that call income, collecting the dividend, and keeping that as a fairly aggressive play there. CBA, out of all the banks, it's obviously the most defensive, but it has had the least correction in price and percentage terms. I think at best CBA just bounces along sideways, may move a little bit higher in line of our view that the index probably has some technical bounce off the back of some stabilisation in the upcoming US earnings. Coca-Cola, we're seeing a lot of negative research published in the last week that's weighed on the share price. I think the company can still deliver 50 cents of earnings per share, pay out about 40 cents of that in dividend, puts it on about a 5.5% yield, but from a technical perspective, the structure's still negative. Computershare, same thing here. The structure's negative. The company, I think, has earnings that are at risk, and it's a stock that I would not be a buyer of. And if I was holding Computershare, you need to be very aggressive with selling the covered calls to help mitigate some of that downside risk. CSL, so healthcare and infrastructure are still the strengths of the market. Starting to trade on a very high PE. On less than a 2% dividend yield, but the attraction here is it's almost growing earnings at double digit, and the company's continuing to buy back shares. So I think we're at a stage where the stock's expensive and it probably tracks sideways. Caltex, so one of the few stocks growing earnings, again close to around 10% earnings growth, solid dividend, beneficiary of lower oil prices as their refining margins are able to creep back up. At these levels, though, it's reasonably expensive. To the extent that we own it here, we've been selling tight covered calls over it. I think it largely moves sideways, but it is a defensive area to have capital parked and to generate that 10% cash flow from the call option and the dividend. Crown Casino, we're seeing continued weakness in Macau. Arguably, we're probably close to the bottom of the cycle, though, where there is some chance that there's a privatisation of Crown, in which case any takeover of the company will probably be at something like $14.50 a share. So if you're looking at shorting Crown, I think you just need to be a little bit careful of that takeover prospect that may loom. Not doing there in Dexus at present. Goodman Group, not doing anything there either. Our preference remains GPT within the property space, trading on about a 5.5% dividend yield, and one of the few property stocks with a bullish structure in place. IAG, as I alluded to in the last recording, we're seeing insurance margins across the board under pressure. At $5, I think IAG's okay value. We've sold the $5.50 covered calls over it. They expire at the end of January. I think sort of on a 5.5% dividend yield, probably not much in the way of earnings growth. The stock trades sideways and you need to be selling covered calls over it. IPL, we'd own this at lower levels. We'd taken profit. We're concerned of the negative structure here in place. That's played out. Even right at the moment, we're not buyers of IPL. We're staying clear of that. James Hardie, so in the last recording, I mentioned that down here was probably a reasonable buy. Expect a technical or a counter trend bounce back up to around 1750. We've got that, and we're now in the next leg of the sell-off. It worries me that price is breaking below the prior low, and it may be that it remains under pressure short term. Lendlease, so this is an area, the stock, the trend's negative, so the pressures to the downside in any trade's a counter trend trade, which always carries higher risk. What I will say is a lot of fund managers have started adding Lendlease into their model portfolios, and that at the margin may provide some buying support there for Lendlease. Not doing anything in Mirvac at present. Medibank Private, I think we saw a earnings result in August that exceeded market expectations. So if we look back around this period, the market assumed the worst. The earnings result came out and it was a lot better. It may be the case that in February, March, when they report their earnings, a similar thing happens again. So if we do see a rally back to around $2.30, we take that opportunity to sell the covered calls over Medibank Private. Macquarie, again, one of the handful of stocks that still has a bullish structure in place, albeit getting down to a pretty tight condition here. So keeping in mind that the broader index is sort of under pressure, so any of these buying opportunities still counter trend versus what the index is saying. NAB, as with ANZ, I think maybe getting down to a point where we do see some technical bounce in the banks. Newcrest Mining, so tie this back into the gold chart. So interesting where gold's continue to go down. Newcrest is gradually developing sort of a higher low structure, and right at the moment $13 seems to be some support where the stock could push higher off that. Origin, all these oil and gas names continue to remain under pressure. We're probably getting reasonably close to seeing some sort of corporate action within this space and consolidation, which will help to alleviate some of the suffering that shareholders have had within this space. Probably Origin, it would appear, out of most of the stocks, would seem to have the best prospect of a recovery, and I guess that's something that needs to be thought about in whether we're consolidating energy exposure and trying to identify which name's likely to have the best and quickest recovery. Maybe Origin's that name. Orica, not doing it there at present. Oil Search, so interesting that obviously this stock held up well whilst Woodside Petroleum had its takeover proposal in place. Now that that's been removed, we're seeing downside pressure on Oil Search. QBE, in line with insurance margins going lower and US interest rates moving lower, it's been hard for QBE to find much buying support. I think we see a rally back to around $12.50, but don't see too much more upside than that short term. Ramsay Health Care, one of the few stocks with a bullish structure in place and a higher high and a higher low, and it may be that it finds support here off around $60. Rio, so we got the production numbers coming out for BHP, Rio, Woodside Petroleum this week, Origin as well. I should say Origin and Fortescue are next week, but we certainly have Woodside Petroleum this Thursday, and we have Santos at the end of the week. But that'll give us a bit better read on where the production numbers are across these resource and energy names towards the end of next week. South32, this stock remains under pressure, but arguably getting oversold. So this is, again, one of the strengths of the market. Scentre Group, the yield's compressing down 5%. Don't see too much more upside. It is expensive, but at around $4, it's a pretty safe buying opportunity. SEEK, the technical structure here has turned negative. We're mindful of the company missing earnings by about 10% in their last earnings result, and I'll probably be a little bit cautious coming into this upcoming result. Stockland, so we own this at lower levels. We've been aggressive selling the covered calls. We collected the December dividend and the extra income off the call option, but the structure still looks negative there. Sonic Healthcare, so this is again one of those few stocks that we've been buying here. Been minor buyers of it off this $17.50 level. Any rally back above $18, I think selling calls at around $19 is the strategy there. Don't look for too much more recovery than that. Santos, I guess I covered that. It'll be interesting to have a look at their sales and revenue release, which comes out this Friday. That'll give us a bit better insight into what's happening there. Suncorp, we continue to see the insurance margins under pressure. Suncorp probably trades somewhere in the order of a 5.5% dividend yield. Banking sector continues to perform okay, and it's worth probably just keeping an eye on this as a potential counter trend trade as it's getting down to a reasonable discount. On the upside, this is one of the stocks that we've been buying, Sydney Airport. This is probably the stock that we've been the most aggressive in over the course of the last week or so. And we'll give it another day or two, see whether it trades up to around $6.50, in which case we'll just lock in the profit. Otherwise, if it languishes around this level, we'll move out, sell a $6.75 call over it, collect the upcoming June dividend and that extra call option income there as well. But the most important thing there is that we're on the right side of a stockless bouncing in the market there. Transurban came out with their December quarter traffic numbers today. The numbers looked okay. The stock is expensive here, compressed down to a 4.5% dividend yield, but on a 2 or 3 year outlook, we should see the dividends grow from around 40 cents a year up to around 50 cents. So it should at the margin help to underpin a gradual increase in price. But if we don't have a backdrop of global interest rates and domestic interest rates falling, I don't think Transurban's got anywhere near the upside like we've seen over the course of the last year or two. Telstra, the market's just a little concerned here that they're able to maintain their earning margins in light of increased competition. I think we're probably at a level where Telstra just trades sideways, but any opportunity to sell the covered calls to enhance the returns, we're taking that. Westpac, probably with the, when you compare sort of the price structure in ANZ and NAB, Westpac's held up pretty well, as has CBA. And I think we're in an environment where these move sideways. Maybe there's a little bit more technical recovery opportunity in ANZ and NAB given how oversold they are. But I do think the Australian banking sector, at best probably bumps along sideways with maybe a chance of a short-term bounce off the back of sort of the improved US earnings. We've seen Wesfarmers make an announcement that they're buying into the UK hardware business, roughly $700 million at roughly a 5% dividend yield, trading on a fairly high PE ratio, but dividend certainty. I think Wesfarmers is a sensible place to have money parked, but we have been aggressive with the covered calls and through the call option, boosting that cash flow up to around 10% per annum from Wesfarmers through the call option and the dividend. Westfield, one of the few stocks that we have been buying. So again, I said there was only a handful of them, and literally there's probably only 5 or 6 stocks as we went through the top 50 that we've been active buyers of. Westfield's one of them. Selling covered calls back up at around $6.75 to $10. Not looking for too much more upside there, given that the yield has compressed substantially there in Westfield. Woolworths, we've seen them come out and announce that they're going to scrap the Masters hardware. So the exercise of the put option with Lowe's there, we'll see them in the coming months look to either close the Masters hardware business or sell it off. So, one would hope that they're able to effect some sort of trade sale there as a going concern. If not, obviously it'll be a break up and a sell down of the real estate assets, which will see Woolworths, focus on their core liquor and grocery business. There's a lot of short exposure in Woolworths that at some point will need to be covered. And I think you just need to be a little bit cautious that there could be a reasonable sharp bounce to the upside, but that needs to be put in perspective that it's not going to be a quick turnaround for them with their grocery business, given the pressures from Aldi and Coles. It is worth noting that obviously Coles is managing to grow earnings at around 10%. So if Woolworths can get the costs down and get the right focus there by management, maybe there's a turnaround story there over the next year or two. At these levels, and you assume all things being equal, post the Masters being stripped out, arguably Woolworths is worth somewhere around $25 to $26 a share. So we've been driving call option income over the last few months out of Woolworths, and we've got the 24.50 calls that expire at the end of this month. And with any luck, we see the price push back up to around that $24.50 level, in which case we can lift the call price back up to around $26. And I think that sort of captures any sort of recovery over the next 6 months in Woolworths. Woodside Petroleum, so as you'd expect, weakness here off the back of the lower oil prices. The structure remains negative. But the rubber band with oil can probably only stretch so far, and there we are back to the index. So in summary, again, there's a handful of stocks there, mainly infrastructure, mainly healthcare, some defensive industrial business like Amcor, possibly Brambles make a fit for portfolios at present. On the next rally up, we can have a look at opportunities to get more aggressive with either taking profit on stocks or selling call options. But right at the moment, I'm think that the short trade seems to be reasonably crowded right at this point in time, and there is a risk that S&P 500 earnings actually look okay over the next week or so, which helps to underpin markets. On that note, thank you for listening in. I look forward to presenting again next month, and we'll leave next month's recording till the middle of February, at which time we would have probably be halfway through sort of earnings. So just to give you a couple of names that kick off in that second week of February, we've got AGL that report their half-year results. We've got CBA, we've got CIM, and Computershare, Stockland. So they all kick off earnings on the 10th of February. On the 11th of February, we have the ASX, Rio, Suncorp, Transurban. And then in the following week, we have AZJ, CSL, NAB, Coca-Cola. So certainly from that period, from the 10th of February, really through till the 26th, it's a bit of an action-packed week for looking at the earnings results. So I'll ensure to put a recording together and focus on those results as they come out. Thank you for listening in. I look forward to speaking again next month.